Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome back to the deep dive. So let's think about this for a second. When it comes to investing, are you better off trying to harpoon one of those few, headline-grabbing whales? Or is the smarter strategy to optimize for the abundant schools of smaller, quicker fish?
It's a great analogy.
Today, we are diving deep into private equity, specifically tech buyouts, and we're looking at some powerful data that really flips the whole go big or go home idea on its head.
It really does.
We're going to show you why size, it actually matters in reverse when you're trying to maximize your returns in the sector.
Right.
Our mission today is to distill the core insights from a really significant piece of research on this. And for our deep dive, we are drawing heavily from the analysis and comprehensive research compiled by Lateral Investment Management in their recent private equity strategy white paper.
And what's so fascinating here is that we're really looking at two layers of specialization. First, you have the technology buyout itself.
Okay, so what exactly does that mean?
It's just a specialized private equity fund that only focuses on acquiring and scaling stable, often pretty mature software and tech businesses. That's the first key.
Right, the tech focus.
Exactly. But the second layer, and this is the real story, is fund size. The data suggests this counterintuitive truth. Going small in tech buyouts can get you performance figures that the mega funds just can't touch.
The small tech buyout advantage.
That's it.
Okay, so let's unpack that. Before we even get to fund size, let's just establish the baseline. Does specializing in tech actually pay off compared to just a generalist strategy?
Oh, absolutely. It's not even close. If you just compare tech buyout funds all sizes against your median North American generalist fund, the specialization gives you an immediate, really noticeable alpha.
Okay, let's start with the gold standard, net internal rate of return, or IRR. For you listening, that's the time-weighted measure of performance. What's the tech focus get you?
So tech buyout funds all in achieve a median net IRR of 23.9%.
22.9%. And how does that stack up against the generalist funds?
They're sitting at 19.8%.
So that's a 4-point gap right there. That's huge just for picking a specialty.
It is. But I think the multiple on invested capital, the MOIC, tells an even clearer story about the value being created.
Right. MOIC is simpler. For every dollar you put in, how many dollars do you get back after fees? So what are the tech funds doing there?
Tech buyouts are hitting a median MOIC of 2.54x.
And the generalist funds?
They're at 1.91x.
Wow. So on every single dollar, the median tech fund is returning about 63 cents more than the median generalist. I mean, that really puts the power of specialization in perspective.
It does. And if you think about the bigger picture, just having a tech focus puts your median fund almost on par with the top quartile of general PE funds.
So the average tech fund performs like a top-tier generalist.
Basically, yes. The top quartile for generalists is around 25.6% IRR and 2.82x MOIC. So tech as a sector just provides this incredibly high-performance floor. But, that's really just the beginning of the story.
This is where it gets really interesting. So specialization is proven. Now, what happens when we slice the data by fund size? We've got small funds under $700 million, large funds over $2 billion, and then the megas over $5 billion.
And the small funds, they just dominate.
Okay, give us the numbers. The small tech buyout funds under $700 million, what's their median net IRR?
It jumps again. It hits 25.9%, which is actually the highest reported figure across the entire data set.
The highest? Wow. But I hear the MOIC is the real headline here.
That is the headline. The net MOIC for small tech buyout funds is a median of 3.39x.
3.39, that is a staggering multiple. It just completely turns that idea that big money gets the best returns on its head.
It does. I mean, for you, the learner, think about that in dollar terms. You put $100 million into a small fund hitting that median, you expect to get $339 million back after all fees.
And now we have to contrast that with the biggest players, right, to really
Right.
see the scale of this advantage.
Exactly. So let's look at the large tech funds, the ones over $2 billion.
What are they yielding?
They're getting a 22.5% IRR and a 2.23x MOIC.
So that same $100 million in a large fund gets you back $223 million.
Right. And the difference between $339 million and $223 million, that's a $160 million gap. On the same initial investment, that is the alpha that the small funds are capturing.
So it's not even a small difference, it's massive.
It's huge. And it strongly suggests that these small funds are finding these unique, less efficient, and highly profitable opportunities that are just inaccessible or, frankly, not worth the time for the big players.
Okay, so let's drill into that. The competitive landscape. Why? If the largest firms have the most money and resources, why are they being so consistently outperformed by smaller funds in the lower middle market, the LMM?
It's a great question. And it really comes down to a fundamental imbalance between where the capital is and where the deals are.
Yeah.
The LMM is just enormous.
Let's talk about that opportunity pool. The research shows over 100,000 smaller companies.
Over 100,000. And they make up something like 90% of all potential private equity targets.
Yeah.
It's that ocean of smaller fish we talked about.
Vast and abundant. And the small funds, the ones getting that 3.39x, they're playing right in that sweet spot, right? The $25 to $50 million deal size.
That's their native habitat. But here's the crazy part. The vast majority of the money isn't fishing there.
It's all chasing the big ones.
Precisely. The data shows that over 80% of all private equity capital, so money in funds over $1 billion, is chasing only about 15% of the total deals.
The big headline-grabbing deals over $250 million.
Exactly. So you have this huge capital bottleneck. 80% of the money is fighting tooth and nail over a tiny 15% sliver of the market.
Which, of course, creates insane competition, drives up the price you have to pay.
And it just squeezes your margins. It's a structural headwind for the big funds. Meanwhile, the LMM is left with far less competition and this abundance of opportunity in that $25 to $50 million range.
And the deal sourcing stats really back this up, don't they?
They really do. For deals with under $10 million in EBITDA, which is a core of the LMM, only 18% ever go to a full, broad auction process.
18%. Think about that. So 82% of the time, these small funds are not in a massive bidding war.
Right. They're getting those deals through proprietary channels or a very limited process, which means they can get in at a much better entry price.
And getting a good entry price is, what, half the battle?
At least. The other half is value creation, and that's also different in the LMM. It's much more hands-on.
You're not just looking for big market shifts.
No. You're looking for specific, correctable problems. Things like moving an old software platform to a modern SaaS model, or fixing the pricing, or bringing in a professional sales team where it was just founder-led before.
Stuff that just doesn't move the needle for a multi-billion-dollar fund.
Exactly. But it's what drives that 3.39x multiple in the LMM.
Okay. Now, for the learner, this is really important to understand. We've laid out these spectacular median returns, but it's not a guarantee. This strategy has a trade-off. It comes with higher variance.
Right. You have to look at the data visualization, the scatter plot.
Yeah.
It shows what we call dispersion. And for net MOIC, you see a much, much greater dispersion across the smaller funds.
So you have these incredible winners pulling that median way up to 3.39x.
But you also have significant outliers on the low end. It just confirms that selectivity is absolutely critical. You might hit a grand slam, but there's also a higher risk of striking out.
It's a high-risk, high-reward play. What about the big funds? Is their dispersion different?
Oh, much different. The larger funds, those over $5 billion, they show much tighter dispersion. Their returns are lower, for sure, but they are safer, more predictable bets.
Less variance between their best and worst performers.
Exactly. They basically trade that massive 3.39x upside for stability.
Right.
You get a consistent, solid performance, while the small funds offer that potential for alpha if you pick the right manager.
Which brings us to a really fascinating point about the life cycle of these firms. A lot of successful tech buyout firms, they start small, they prove the model, and then they scale up fast.
They do. They kill it in the LMM, they post these huge multiples, and then they use that track record to go out and raise a much, much bigger fund next time.
But the data suggests that scaling up might actually be, well, a trap. a self-limiting strategy if you want to keep those high returns.
It is. I mean, think about it. When you go from a $500 million fund to a $5 billion fund, you simply have to do bigger deals to deploy all that capital.
You're forced out of your sweet spot.
You are. You're forced to compete for those larger, more competitive deals. And the source material is clear. That move is historically associated with tighter dispersion and lower MOIC upside. It's a structural problem. The more successful you are at raising capital,
The harder it is to maintain those outlier multiples because you're now playing in that crowded, expensive 15% of the market.
Exactly.
So what does this all mean for you, whether you're analyzing strategies or just thinking about capital? The core takeaway seems crystal clear. The highest return potential in private equity tech buyouts is in the lower middle market. It's leveraging that sheer volume of companies and the lack of competition for those $25 to $50 million deals.
But, and this is a big but, it's a high alpha strategy that demands surgical precision. Because of that greater dispersion, you have to be incredibly selective. You need deep expertise to find the winners, the 3.39x funds, and avoid the others.
It all comes down to picking the right manager.
It does. And that raises a final sort of provocative thought, doesn't it?
Go on.
Well, if scaling up inherently reduces your potential for that spectacular MOIC, does success in the LMM ultimately lead to a self-limiting strategy? Does a fund manager eventually have to choose between growing their firm,
Which grows their management fees.
right, between that and maintaining the highest possible return multiples for their investors? It's a fascinating paradox.
The paradox of success, a great place to leave it. Thank you for joining us for the deep dive into the small tech buyout advantage. We'll catch you next time.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.